Hi Team Value, JJ here, welcome back. Well, the 13F filings are out from super investors for Q1 2024, and I wanted to dig in and see some of the small caps they're invested in because I'm heavily invested in small caps. I like small caps because of the possible long runway for growth if they're good quality companies, and you'd think that some of these investors would be looking for good quality companies. So let's see what they've been investing in. Let's get into it. We're going to start at David Einhorn, so let's see what he's been getting up to. It's over a $2 billion fund. They have 42 stocks there. And we can see the top position there is Green Brick Partners at nearly 29% of the portfolio. They've reduced that by 8.22% in the quarter. We can see here that Green Brick Partners has a market cap of around 2.58 billion, enterprise value of 2.7 billion. What does the company do? Green Brick Partners is a home building and land development company. It acquires and develops land as well as provides land and construction financing to its controlled builders. If we have a look at some of the metrics for the company to see why he might be interested in this, we can see that it's got a gross margin of 32, operating margin of 21, and the return on capital employed here is 22.79, which is pretty high. Anything over about 15, the S&P 500 average around there is very good, so I can see why he might be interested in this. Just looking at the PE ratio, we can see it's 8.7, forward PE ratio of 6.95, so we can see why David Einhorn might have been interested in this company. The company's up 10.78% for the year to date. Above the low, it's up 50.38% over the past year. You know, stocks fluctuate up and down within a year. Over the past 3 years, it's up 156%. So it's been doing well. I can see why that David Einhorn might have been interested in this home building company. There have been a number of super investors interested in home building companies. There's another one in the slot, which we'll see later. Next, we're going to have a look at Daniel Loeb from Third Point, which is nearly $8 billion fund. He does have a small cap here that I noticed. So in Q1 2024, we can see Cinemark Holdings there is a buy of 5 million shares. Cinemark Holdings is a $2.16 billion market cap company and $4.93 billion enterprise value. So carrying a significant amount of debt there, it looks like. If we have a look at some of these metrics, we can see the gross margin is 64 and the operating margin is 11.87, and the return on capital employed is less than 10, so below average, but the return on equity here says 81. P ratio is 12 and the forward P ratio is 33, so quite high there. But what does the company do? Cinemark Holdings is a geographically diverse operator in the motion picture exhibition industry in the US. The company operates around 518 theaters and 5,847 screens across the US. Does remind me a bit of AMC. I did hear an investor saying quite a long time ago, when AMC was being a meme stock, why wouldn't somebody be more interested in Cinemark rather than saving AMC? And obviously Daniel Loeb here is interested in that company. I don't know why, but we're not going to dig any deeper today, but it's interesting that he is invested in AMC competitor, really, I think it must be. Next, we have Lee Ainslie from Maverick Capital, and they own 403 stocks, which is a huge portfolio, not a concentrated value fund. And I do think that he's more on the growthy side of things after hearing a podcast interview not long ago. And what caught my eye in the small cap realm was this company here, Revolve Group, adding 107% in the quarter. Let's have a look at Revolve. Revolve Group has a market cap of $1.56 billion, enterprise value of 1.33. So definitely in the small cap realm there. Why is Lee Ainslie interested in this company? What does the Revolve Group do? The Revolve Group is an emerging e-commerce retailer selling women's dresses, handbags, shoes, beauty products, and incidentals across its marketplace properties. Revolve and FWRD Forward. The platform is built to suit the next generation customer, emphasizing mobile commerce, influencer marketing, and occupying an aspirational but attainable luxury niche. So probably targeted at Gen Z from what I can see there. It's the first time I've looked at it. We have a look at some of the metrics quickly. We can see that the debt looks all right, low debt, Gross margin 52, which is probably reasonably high for the industry, I think. Operating margin only 1.18 at present, and the return on capital employed is pretty low at this point. The PE ratio is 64.71 and the forward PE is 43.1. If we look at this value graph here, we can see that it did get a huge spike back there in 2021, like a lot of emerging tech stocks. So I'd say it would have been caught up in that, and it's definitely gone down a lot then, which is probably why they're interested in it right now. Year to date, it's actually up 32%. And above the low, it's 52%. But adding in the first quarter, they're trying to get the upswing momentum up from the big dive that it's taken over the past 3 years or so. It's actually down 54% still over 3 years, but 75% above that low. So it's definitely trending back up again. Now, if you're getting value out of the Super Investor Small Cap episode so far, I'd really appreciate it if you remember to smash that like button to help the algorithm to spread it to more people. And if you're not a subscriber yet, maybe consider hitting that subscribe button as well. Next, we have Bruce Berkowitz from Fairhome Capital with only 7 stocks, so pretty concentrated here. And St. Joe is the top one there with 86%, which is a massive position. But down here we see Ozark Bank, which they added 533% in that past quarter. And that, for a bank, is a small cap. It's not strictly a small cap, but for a bank, it's pretty small. So let's take a quick look at that. We can see here that there are 3 investors on this list that own this bank as well, including Lee Ainslie, who we've just looked at and been adding to this recently. And this is a $5.49 billion bank, enterprise value of 4.18. So as I said, maybe a bit past small cap, but for a bank, that is pretty small. Now, the name of the bank's pretty explanatory, but we'll have a look here. Bank Ozark is a bank holding company that owns and operates a community bank, Bank of the Ozarks. The bank operates offices in Arkansas, Georgia, Florida, North Carolina, Texas, California, New York, and Mississippi. So a regional bank, and we had that regional bank crisis last year, but there are some good regional banks. Could this be one of the good ones? We've got a number of super investors here investing in it. I haven't checked this bank out, but it would be interesting to dive more into, I think. Now, if we look at some of these metrics here, they look pretty good. The return on equity is nearly 14. ROA is 2.14, which is pretty good for a bank. P ratio is 8.12. Forward P ratio 7.84. This year, it's actually down 2.51%. Over the past year, it's up 35.74%, which is 40% above the low that it got to. Now, it's just an indication, but GuruFocus here does indicate that it's somewhat undervalued. We'd have to dive into it. We'd have to dig way into this to see if that's correct. But obviously, with these super investors investing in it, it could be something to dig into. And as I said, for a bank, relatively small cap. So is there upside for this bank? Is there a lot of upside? You know, banking can be one of those ones that can go to zero if they get into trouble, but this might be a good start of fishing where the fish are in terms of some of these investors getting into it. They can be wrong, of course. Now, Viking Global Investors, which has 83 stocks, so not a small focused fund, a lot of stocks here. But what caught my interest here was this one down here, Reddit. They've bought Reddit. There are actually 3 investors on this list that own Reddit. A recent IPO, of course. Reddit's not really a small cap, more of a mid cap, 10.14 billion, the value of it at the moment. It's something that I hadn't really considered, Reddit, but maybe it is something to have a closer look at some point, even though it's not a small cap. I am interested in social media companies. Haven't ever invested one, not even in Meta, but you know that I hadn't really considered the possibility of Reddit being a good stock over time. If we look at the numbers here, gross margins are pretty good. It's still early days. Now this one caught my eye as well. Glenn Welling from Engaged Capital with only 11 stocks, so pretty concentrated. A $617 million fund. I'm not aware of this investor. I don't know who they are, but down here, Portillo's Inc. was a buy for the quarter, and that is a small cap, a fast food chain that's recently IPO'd, and I did see a recent thesis on this from the Chit Chat Stock guys who do a podcast. It's worth having a look. They went in depth in their latest show talking about Portillo's. It's a Chicago fast food chain. Let's have a quick look at it. So Portillo's is definitely still a small cap, only $651 million company and $1.2 billion enterprise value, so having a bit of debt there. Portillo's serves the Chicago street food industry through high energy and multi-channel restaurants designed to ignite the senses and create memorable dining experiences. So in the Chicago area it's been, but as I understand it, they do want to expand, and as we know in the United States, these fast food chains that do well, they can have hundreds of outlets. If we look at some of the successes like Chipotle and Wingstop, which is pretty expensively priced at the moment, so this might be one to watch, one to dig into. So if we look at some of the initial metrics here, and remember it's still early days, they don't look so great. Gross margin of 40, operating margin of around 8, return on capital employed still pretty low. The PE ratio is sitting at 26 and forward PE of 27, so not exactly cheap, you wouldn't say. Year to date it's down 32.33%, so this is actually interesting. If it goes down more, it may become more interesting. And since the IPO it's down over 63%, so taking a dive. This one might be worth putting on the watch list, digging into it, doing more investigation and research and watching to see how it goes. Now I don't talk much about small caps on the main pod here, but I do talk quite a lot on Patreon about them because, as I said, I'm heavily invested in small caps. So if you're interested in that, I'll leave a link in the description and see you over there. And this is investor Bryan Lawrence from Oak Cliff Capital, running $166 million. I think this is a family office. He recently had a very long podcast interview with William Green on the Investors Podcast Network, which is really worth listening to. And he went through the stocks. He's pretty focused, only 10 stocks here. And what caught my interest here is LGI Homes Limited, another home builder. We've already seen one. This is another one. And Warren Buffett's invested in home builders fairly recently too. So interesting that we have another one here. He's added 181%. Let's have a quick look at it. This is LGI Homes. We can see here it's 2.47 billion. So small cap, relatively small cap. Enterprise value of 3.88 billion though. Okay, let's have a quick look to see what it does. LGI Homes is engaged in the design, construction, and sale of new homes. The company's current product offerings include entry-level homes, including both detached homes and townhomes, and move-up homes, which are sold under LGI Homes brand, and luxury series homes, which are sold under the Terrata Homes brand. Now, given this is a small cap home builder and that Bryan Lawrence, who's a good investor, he's been beating the market over quite a long period as I understand it. Be interesting to see why he was interested in this particular home builder. We've got a gross margin here of 23.64, operating margin of 10. We see the return on capital employed is fairly low. PE ratio about 13 and forward PE ratio of 11, so not too high then. Year to date it's down 20%, and he added to it in that first quarter. Over the past 3 years it's down 12%, and above the low it's up 22.66%. Next, we have Terry Smith from Fundsmith, a very well-known investor, often referred to as the UK's Warren Buffett. And he wrote this book, which is a really good book. I'm going to put a link in the description to it. If you want to read it, I highly recommend it. It's his writings over the past 10 years or more about his fund and how he invests. He does have a value bent, but also growth and value. And what's interesting about what he bought in this past quarter for Fundsmith, well, actually, it's not for Fundsmith, it's for Smithson, which is the small and mid-cap fund. I just watched a video on YouTube that was the annual general meeting, if you're interested in this, and they talk about this company, Oddity Tech, which is a small cap, very sort of hyper growth company, in fact. So that interested me that they would invest in this company coming from a value background. They also invested in Paycom, which is more of a mid-cap company. It's come down a lot in value, so I can see from a value point of view why they're investing in that. It seems to be a quality company and it's gone down hugely in value, so sort of buying the dip. A big slide there. We're not going to look at that today because it is on the bigger side, but we're going to have a quick look at Oddity, see what that's about. Here it is, Oddity Tech, and we can see that it's currently a $2.41 billion company, enterprise value of 2.27. And what does the company do? Oddity Tech offers a consumer tech platform that is built to transform the beauty and wellness market. The Oddity platform is designed to support a portfolio of brands and services that innovate and disrupt the expansive beauty and wellness market. So disruption there, that's a commonly used word. Is it truly disruptive? It consumes user data to develop physical beauty and wellness products that deliver performance and functionality. Its brands include Spoiled Child and El Maquillage, something to look into there if you're researching those brands, see how they're going. They obviously sell online. They say they use AI as well, so that's a buzzword of the time. I would sometimes dismiss a company like this, but because that Smithson and Funsmith, Terry Smith, is behind this or invested in this, that is of interest to me to look deeper into this. And with a quick look at the metrics here, they look pretty incredible here. We've got next to no debt. We've got a gross margin of 71, operating margin of 16, net margin of 13, and return on capital employed is 34. Mind you, this is a recently IPO'd company. To see metrics like this on a recent IPO, we saw what Reddit looked like, but this is a profitable company growing very fast. PE ratio is 35 and the forward PE is 30. So that seems pretty high, but with a return on capital employed of 35, maybe not so much. I can see why they might be interested in this. So all the metrics look pretty good for this company, something to dig into, and growing pretty fast. We can see 3-year revenue growth rate of 65%. So a very interesting company to look into, I think, this one. Next, we have Greg Alexander from Conifer Management, and I believe that Warren Buffett himself said good things about Greg Alexander at one time. And what caught my eye here was this company, Rimini Street. It's not in the latest quarter, but Q4 2023. Hadn't heard of this one before, and I had a quick look. It is a small cap. So this one's only nearly $219 million market cap, so pretty small, enterprise value of 169. And what does this company do? Rimini Street is a provider of enterprise software, support products and services, and a third-party support provider for Oracle and SAP software products based in the United States. The company offers solutions to run, manage, support, customize, configure, connect, protect, monitor, and optimize clients' enterprise applications, databases, and technology software platforms. Gross margin of 61.62, as you expect with a software type company, tech company. Operating margin of 10, and the ROCE has 82 here. The PE ratio is only 10, and the forward PE ratio is 8, so I can see why he might have been interested in this. If we look at the year to date, it's also down 27%. We'd have to look at the reason why, the market's sending it down. Over the past year, it's down 40%. Over the past 3 years, it's down 61%, so not doing well so far, but those metrics are looking pretty good. I want to dig into this company and see what's going on here. What's the reason that the market doesn't like it? Now, did any of those small cap companies catch your eye to dig more into? Let me know in the comments what is most interesting to you to dig into. I'd really like to know. Now, if you're watching this episode on YouTube, I'm going to put a link here to a previous episode about small caps, about what Warren Buffett said about small caps and how he'd be investing in them if he was starting out again today. So go and see that now. If you haven't seen that already, I'll put a link in the description for those watching elsewhere as well. And thanks to everybody for watching or listening to this one, and I'll see you in the next one.